Let's also chat with Gulf Oil Lubricants, the first corporate management that we have on our show today. The company recently entered into a strategic partnership with Nayara Energy to expand its automotive product offerings. So, they're launching a range of lubricants across India. We'll talk about that with Manish Gangwal, Chief Financial Officer at Gulf Oil Lubricants. Mr. Gangwal, thanks for joining in and thanks for taking the call. We'll get to the tie-up and your new offering in just a bit, but the bigger sort of market concern this morning is this big surge in oil prices. Now, when we spoke with you in December, at that point, obviously, this was not a concern, and you told us that, things are pretty steady on the margin front. What is the sensitivity for you, say, for every dollar increase in Brent? Can you give us some sense of what that impact is on margins and how you're looking at the current surge with now Brent above $81?
Yeah, good morning. Thanks for having me. Yeah, I think you're right. The crude has really surged in the last 1 week or so in a way which was not anticipated. Everybody was talking about, and the global scenario was like China demand is low and the crude is going to remain subdued in a way. We are seeing suddenly a jump from nearly $70, $72 to now $80 plus. Obviously, for us, our key raw material is base oil, which is a derivative of crude, of course, but the effect comes with a lag. So usually there is 1 to 2 months of lag before the impact is seen on the derivative base oil. And we get enough time in between to, take our pricing calls and, manage our margins. We do carry some inventory also, base oil, obviously, because it's an largely imported commodity. So obviously, we will watch for this crude movement. Obviously, if the crude remains at these elevated levels or touches around $85, and the pricing decisions may need to be taken in terms of margin management. But as of now, we have to wait and watch. Another obviously thing is the rupee depreciation, which has happened in the last 1.5 months, which also impacts our landed cost in terms of, because mostly the base oil is imported, as I mentioned. So both of these have to be combinedly seen, and then we have to really take our decisions. But obviously, we have to watch this space very closely for margin management.
No, absolutely, and I'm glad you brought up the other important point as well. The rupee depreciation is not helping for importers. So again, some sense, Mr. Gangwal, in terms of your margins have been around 12.5%, right? Now that you're dealing with not one but two headwinds, what is the price elasticity that you have in the market? How much, if we look at numbers, immediate numbers available with the rupee depreciating and oil prices escalating, if you want to entirely mitigate the margin impact, then how much of a price increase will you need to take? You may or may not take that kind of price increase, depending on competitive intensity in the market. But what is the quantum that could be needed, seeing these two factors play out?
So in the past, we have always seen that when these kind of movements have happened, we have been in a position to pass on the increases to the end consumer customers. And especially in our OEM businesses, we have a price variation clauses which are triggered quarterly in most cases. So obviously with that, we'll be in a position to mitigate the margins. To give you a ballpark figure, it's very difficult because there are various grades of base oil which has demand-supply situation also. Sometimes the Group 1 base oil becomes less available as compared to Group 2. So there are various permutation combinations. But in a sense, we do not take price increases or price schemes. We usually adjust in short term with the scheme management. And if there is a sustainable increase over a period, then we may have to change the prices at the MRP level. So that is a wait and watch situation as of now. And I can only say that we will be definitely watching for the next 15-20 days in terms of how the movement is happening. And then post budget, maybe we will be taking some calls on the pricing, which can be either by way of adjustment of schemes or by way of MRP level increases. But to really give a figure at this moment depends on how the crude and rupee behaves between now and next 15-20 days.
But Mr. Gangwal, can you assure investors that there will be no margin hit? Let's talk about exit margins, FY25 exit margins. Where would you want to be?
So typically we are in a band of 12 to 14% EBITDA. And we definitely, as you rightly mentioned, we were at 12.5, 13% band. we would be maintaining that margin band of 12 to 14% EBITDA for sure. That has been our trend. And usually these are the opportunities also when you sometimes take up the price increase and when the crude cools off in a way, you end up retaining some margins as well. So these are sometimes can turn out into an opportunity as well on a longer period basis.
All right. Thank you very much for joining us. It's a pleasure and good luck. We'll speak again post the third quarter earnings, which should be soon as well. So that's Gulf Oil Lubricants. Prakash